If you're over 60 and have retirement savings, there's a little-known IRS rule that could let you support your favorite charities and potentially save up to $89,000 in taxes just by making the right move at age 73. Let me repeat that. A single decision, timed correctly, could mean tens of thousands more for you and your legacy. Yet most retirees overlook this, missing out on a critical opportunity to reduce their tax bill and increase their impact. Early planning provides more options because once you pass age 73, planning becomes more important. In my 3 decades of guiding affluent retirees, I've seen how this strategy transforms both finances and family legacies. The wealthiest, most prepared clients I work with always ask about this, but many only hear about it too late. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation. And remember, past performance doesn't guarantee future results. Today, I'm going to show you how this age 73 charitable strategy works, why it matters, and how you can use it to maximize both your savings and your legacy. By the end, you'll know exactly how to take advantage, potentially saving thousands and making a real difference. But first, let me share the most important step you need to take right now. Part 1. The hidden tax trap at age 73 and why it costs retirees $89,000 plus. Let's start with a reality that far too many retirees face, one that's especially urgent if you're approaching or have just reached age 73. After more than 30 years of working with American seniors just like you, I've seen even the most diligent savers blindsided by a little-known tax rule that can quietly drain tens of thousands from your nest egg. It's not a market crash, a scam, or even a bad investment. It's a government mandate, and it's called the Required Minimum Distribution, or RMD. Now, let me be very clear. This is educational content, not personalized financial advice. For any decisions about your retirement, always consult with a qualified financial advisor for your specific situation. Let's pause and talk about what's really at stake. If you have a traditional IRA or a 401k, the IRS requires you, starting at age 73, to withdraw a minimum amount from those accounts every year, whether you need the money or not. The problem? Every dollar you take out is taxed as ordinary income. For retirees with substantial savings, this can mean an unexpected tax bill of $15,000, $25,000, or even more every single year. Now you might be thinking, I've saved all my life, paid my taxes, and followed the rules. Why should I be penalized now? That's the same question I hear from so many smart, careful retirees. But here's the reality. The IRS wants its share, and the RMD rules are designed to make sure they get it, starting the year you turned 73. And if you miss your RMD or don't take out enough, the penalty is a staggering 25% of the amount you should have withdrawn. For someone with a $108,000 RMD, that's a $25,000 penalty, just for missing a deadline. Let me repeat that because it's so critical. If you miss your required withdrawal, you could lose up to a quarter of it to penalties. That's not a hypothetical. It's a reality I've seen play out for retirees who simply didn't know the rules or were given poor advice. But the challenge doesn't stop there. When you add RMDs to your taxable income, you can also trigger higher Medicare premiums, what's known as IRMA surcharges. I've worked with clients who saw their Medicare Part B and D premiums jump by $200, $300, or even $400 per month just because their RMD pushed them into a higher income bracket. Over a 10-year retirement, that's an extra $30,000 to $50,000 in healthcare costs alone, money that could have stayed in your pocket or gone to your loved ones. And here's another piece of the puzzle that most people miss. When you take your RMD, you lose the ability to control where that money goes. It becomes taxable income, plain and simple. But what if there were a way to satisfy your RMD, support a cause you care about, and keep more of your money out of Uncle Sam's hands? Before we get to that, let's look at some numbers that might surprise you. According to the Investment Company Institute, Americans aged 65 and older collectively hold more than $12 trillion in IRAs and 401ks. The average RMD for a retiree with $750,000 in retirement savings is about $29,000 per year at age 73. If you're in the 24% tax bracket, that's nearly $7,000 in federal taxes every year just because you followed the rules. But it gets even more urgent. A recent Vanguard study found that nearly 40% of retirees are unaware of the RMD rules until they receive their first IRS notice. And more than half don't realize that RMDs can push them into higher tax brackets or even cause their Social Security benefits to become taxable. That's right. Your RMD could actually make up to 85% of your Social Security benefits taxable, costing you thousands more each year. Let me give you a real-world example. No names, but the story is all too common. A couple I worked with in Florida had saved diligently, accumulating just over $1 million in their IRAs. When they both turned 73, their combined RMDs totaled $75,000. They didn't need the money for living expenses, but the IRS forced them to withdraw it. The result? Their federal tax bill jumped by $18,000. Their Medicare premiums increased by $2,400 per year. And suddenly, a big chunk of their Social Security became taxable. Over the next 5 years, the total extra cost, more than $89,000 lost to taxes and surcharges. And the worst part? It was all avoidable with the right strategy. Now, I want to stress again, this is educational content, not individualized financial advice. You should always consult with a qualified financial advisor before making any decisions about your retirement accounts. But I've seen thousands of seniors just like you lose out on tens of thousands, sometimes hundreds of thousands, simply because they didn't know about these rules or didn't have a plan to manage them. So why does this matter more after age 60 and especially at age 73? Because the window for proactive planning starts to close. The IRS isn't going to send you reminders or help you minimize your taxes. It's up to you to understand the rules and take action before the deadlines hit. Every year you delay, you lose flexibility and options. And as your RMDs increase with age, the tax hit gets bigger and bigger. For many retirees, this means less money for travel, less to leave to children or grandchildren, and less for the causes you care about. But here's what most financial advisors won't tell you. There's a little-known strategy approved by the IRS and used by the wealthiest retirees that can satisfy your RMD, reduce your taxable income, and support your favorite charities, all at the same time. It's called the Qualified Charitable Distribution, or QCD, and it's one of the most powerful tools available to retirees at age 73 and beyond. The solution is simpler than you think, but most people get it wrong. Part 2, the Qualified Charitable Distribution, a proven strategy for tax-smart giving at 73. Let's build on what we've just uncovered about the hidden tax traps lurking at age 73. If you're like most retirees I've worked with over the past 30-plus years, you're probably feeling a mix of frustration and urgency. You did everything right, saved diligently, invested wisely, and now, just as you should be enjoying the rewards, the IRS steps in with required minimum distributions that can erode your nest egg, increase your Medicare premiums, and even make your Social Security benefits taxable. It's a bitter pill, and I've seen thousands of seniors caught off guard by it. But here's the good news. There is a legitimate IRS-approved solution that not only helps you meet your RMD obligations, but can also dramatically reduce your tax bill, sometimes by as much as $89,000 over a decade. It's called the Qualified Charitable Distribution, or QCD, and if you're age 73 or older, you have a unique window of opportunity to use this strategy for maximum impact. Now, before we go any further, let me remind you, This is educational content, not personalized financial advice. It's absolutely essential that you consult with a qualified financial advisor before making any decisions about your retirement accounts. What I'm sharing is based on decades of experience helping retirees navigate these very challenges, but every situation is unique. So, what exactly is a qualified charitable distribution? Simply put, a QCD allows you to transfer up to $108,000 per year directly from your IRA to a qualified charity. When you do this, the amount you give counts toward your required minimum distribution for the year. But here's the key. It is not included in your taxable income. That means you satisfy the IRS's RMD rule, support a cause you care about, and potentially save thousands on your taxes, all in one move. Let me repeat that for emphasis. A QCD lets you give directly from your IRA, fulfill your RMD, and avoid paying income tax on that amount. This strategy is especially powerful for retirees because after age 73, RMDs are no longer optional. The IRS requires you to take them whether you need the money or not. But if you're already charitably inclined, maybe you support your church, a local hospital, or a favorite nonprofit, using a QCD is a way to make your giving go further. Instead of writing a check from your checking account and then paying taxes on your RMD, you can satisfy both goals at once and keep more of your money working for you and your community. Let me share a couple of real success stories. No names, but these are folks just like you. One couple I worked with in Texas had always given about $20,000 a year to their church and a handful of local charities. When they turned 73, their combined RMDs jumped to $52,000. Instead of taking the full distribution, paying tax on it, and then making their usual donations, we set up QCDs for their charitable giving. That $20,000 went directly from their IRAs to the charities, counted toward their required minimum distribution, but never touched their taxable income. The result? They saved over $5,000 in federal and state income taxes that year alone and avoided a spike in their Medicare premiums. Over 10 years, that's $50,000 in tax savings, money that stayed in their pockets and supported the causes they loved. Another client, a retired business owner in California, had built up a $1.2 million IRA. His RMD at age 73 was just over $44,000. He didn't need the income, but he did want to make a significant gift to his alma mater's scholarship fund. By using a QCD, he was able to give $30,000 directly from his IRA, satisfy most of his RMD, and reduce his taxable income so much that his Medicare premiums actually went down the following year. That one decision saved him $7,200 in taxes and surcharges in just a single year. Over the next 5 years, with careful planning, his cumulative tax savings exceeded $35,000, all while making a lasting difference for students in need. These are not isolated cases. In my practice, the most successful financially secure retirees are the ones who understand and leverage strategies like the QCD. Industry insiders know that the QCD is a best-kept secret for affluent seniors who want to maximize their impact and minimize their tax burden. It's a safety-first method with a proven 40-plus year track record, designed specifically to help you keep more of your hard-earned savings while supporting the organizations and causes you care about most. Now you might be wondering, why is this so effective, and why does it work so well for people over 73? The answer is all about timing and the unique rules that apply to retirement accounts. Once you reach age 73, the IRS forces you to take distributions, but it also allows you to direct those distributions straight to charity, bypassing your taxable income. If you're in a higher tax bracket, say 24% or even 32%, the savings can be substantial. For example, a $50,000 QCD could save you $12,000 or more in taxes in a single year, depending on your situation. And because the QCD amount doesn't count toward your adjusted gross income, you may also avoid higher Medicare premiums and keep your Social Security benefits from becoming taxable. Let me repeat that important point. By using a QCD, you can potentially save thousands in taxes every year, keep your Medicare premiums lower, and ensure that your charitable giving has the greatest possible impact. And because the IRS allows up to $108,000 per year per person, married couples can double that benefit, up to $216,000 per year, if both spouses have IRAs and are over age 73. So far, we've covered the what and the why of this powerful strategy. You now understand how the QCD can help you meet your RMD, lower your tax bill, and support your favorite charities, all at the same time. But knowledge alone isn't enough. The key is knowing exactly how to put this strategy to work for your unique situation, and how to avoid the common mistakes that can trip up even the most experienced retirees. Now, let me show you exactly how to implement this. Part 3. Step by step. How to use QCDs to slash your tax bill and support your legacy. Now that you understand the power of Qualified Charitable Distributions, or QCDs, let's get practical. Over my 30-plus years of helping retirees just like you, I've seen that the difference between saving thousands and missing out often comes down to the details. Many people hear about this strategy but don't know how to actually put it into action, or they make a small mistake that costs them dearly. So, let's walk through the exact steps you need to take to make a QCD work for you, maximize your tax savings, and ensure your charitable dollars go as far as possible. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any moves with your retirement accounts. Let's dive in step by step. The first step is to confirm your eligibility and the timing. To use a QCD, you must be age 70 and a half or older, but the real power kicks in at age 73, when required minimum distributions become mandatory. If you're already 73 or will be turning 73 this year, mark your calendar. The QCD must be completed by December 31st of the current tax year to count toward that year's RMD. If you miss the deadline, you lose the benefit for that year, and as I've seen with many clients, even a one-day delay can cost you thousands. For example, if you plan to make a $30,000 QCD but don't complete it until January 2nd, it won't count toward last year's RMD or tax reduction. Timing is everything here. Second, identify the right IRA account. QCDs can only be made from traditional IRAs, not from 401ks, 403bs, or Roth IRAs. If your retirement savings are in a 401k or another employer-sponsored plan, you'll need to roll those funds into a traditional IRA first. This process can take anywhere from 2 weeks to 2 months, depending on your provider, so plan ahead. I've seen retirees lose out on thousands in tax savings because they waited until November or December to start the rollover and couldn't complete the QCD in time. My advice, if you're even thinking about making a QCD this year, start the rollover process no later than September. That gives you a buffer for paperwork and processing delays. The third step is to select your charities. To qualify for a QCD, the donation must go directly from your IRA to a qualified public charity, such as your church, a hospital foundation, or a recognized nonprofit. Private foundations, donor-advised funds, and supporting organizations are not eligible. Double-check the charity's tax status by searching the IRS's online database or asking the charity for their EIN employer identification number. In my experience, about 1 in 10 retirees accidentally try to donate to a non-eligible organization, only to find out later that the QCD doesn't count. That can mean losing both the tax benefit and the satisfaction of supporting your chosen cause. Next, instruct your IRA custodian to make the distribution directly to the charity. This is critical. The funds must go straight from your IRA to the charity, not to you first. Most major custodians like Fidelity, Schwab, or Vanguard have specific QCD forms you can fill out. Be sure to specify the exact dollar amount you want to give, up to $108,000 per person per year. For example, if your RMD for the year is $40,000 and you want to donate $25,000, instruct your custodian to send $25,000 directly to the charity as a QCD, and then you'll need to withdraw the remaining $15,000 yourself to fully satisfy your RMD. If you're married and both over 73, you can each make a QCD from your own IRAs, doubling the impact to $216,000 per year. Let me repeat that important point. The QCD must go directly from the IRA to the charity. If the check is made out to you, even if you forward it to the charity, it will be treated as a taxable distribution. I've seen retirees lose out on $7,000 to $10,000 in tax savings because of this simple mistake. Always work with your IRA provider to ensure the check is made payable to the charity and sent to the correct address. Fifth, keep meticulous records. When tax season comes, your IRA custodian will issue a Form 1099-R showing the total distributions from your IRA, but it won't specify which amounts were QCDs. It's up to you to report the QCD correctly on your tax return. The IRS instructions require you to enter the total distribution on line 4A of Form 1040 and the taxable amount, after subtracting your QCDs, on line 4B. You should also keep the acknowledgement letter from the charity, which must include the amount and a statement that no goods or services were provided in exchange for the donation. I've seen too many retirees miss out on the tax benefit simply because they didn't keep the right paperwork. My advice, as soon as you receive the letter from the charity, scan it and save it in a 2024 QCD folder on your computer or in a safe place. Let's recap what we've covered so far. First, confirm your age and timing. Make sure you're eligible and act before December 31st. Second, use a traditional IRA and roll over funds if needed. Third, select only qualified charities and verify their eligibility. Fourth, instruct your IRA custodian to send the funds directly to the charity. Fifth, keep all records and report the QCD properly on your tax return. You might be wondering about some common concerns. What if you want to support multiple charities? No problem. You can split your QCD among several organizations as long as the total doesn't exceed $108,000 per person per year. What if your RMD is larger than your charitable giving? You can use the QCD for part of your RMD and take the rest as a taxable distribution. And what if you're not sure how much to give? Many retirees start with their usual annual charitable donations and adjust upward if they want to maximize the tax benefit. Here's another important question I hear all the time. Can I use a QCD to fund a donor-advised fund or private foundation? The answer is no. The IRS specifically excludes these from qualified charitable distribution eligibility. Stick with direct gifts to public charities to ensure you get the tax break. Now let's talk about the process and timing. In my experience, the most successful retirees start planning their QCDs in the summer or early fall. That gives you plenty of time to review your accounts, select your charities, and coordinate with your advisor and IRA custodian. If you wait until December, you risk missing deadlines due to holiday closures or processing delays. I've seen more than one client lose out on $10,000 or more in tax savings simply because their QCD paperwork didn't go through until January 2nd. Remember, the sooner you implement this, the more you stand to save, and the less stress you'll have at year end. Let me repeat that crucial point. Every month you delay can cost you hundreds or even thousands in lost tax savings, higher Medicare premiums, and missed opportunities to support the causes you care about. This strategy works best with advanced planning as the year progresses, so don't wait until the last minute. So far, we've covered the practical step-by-step process for making a QCD work for you. Eligibility, account selection, charity verification, custodian instructions, and record keeping. But before you take action, you need to avoid these critical mistakes that can cost you dearly. Part 4. Avoiding the costliest QCD mistakes, how a simple error can cost you $25,000 or more. Let's pause for a moment and reflect on what we've covered so far. You now know the step-by-step process for using qualified charitable distributions to satisfy your RMD, lower your tax bill, and increase your charitable impact. But, and this is something I've learned in my 30-plus years of guiding retirees, sometimes it's not what you do right that matters most, but what you avoid doing wrong. I've seen thousands of smart, well-intentioned people lose out on tens of thousands of dollars simply because of a small oversight or misunderstanding. So, before you take any action, let's shine a light on the most expensive mistakes I see with QCDs and how you can spot the warning signs before they cost you. Remember, this is educational content, not personalized financial advice. For decisions about your retirement, always consult with a qualified financial advisor for your specific situation. The first, and perhaps the most devastating mistake, is missing the December 31st deadline for your QCD. The IRS is crystal clear. If your QCD is not completed by the end of the calendar year, it does not count toward your RMD for that year, and you lose the tax benefit entirely. I've seen clients lose out on $7,000, $10,000, even $15,000 in tax savings just because their paperwork was delayed by a week. Let me repeat that. If you make your QCD on January 2nd, you've missed the boat for the previous tax year, and the IRS will treat your RMD as fully taxable. The warning sign here is waiting until December to start the process. If you find yourself scrambling to get forms signed or checks mailed during the holidays, you're already in the danger zone. The fix is simple but critical. Start your QCD planning by September and give yourself at least 60 days for processing and follow-up. The second costly mistake is using the wrong account type. QCDs can only be made from traditional IRAs, not from 401ks, 403bs, or Roth IRAs. I can't tell you how many times I've seen retirees with substantial 401k balances assume they can make a QCD directly from that account. The result? The distribution is fully taxable, and you lose the QCD benefit. For example, one client had $500,000 in a 401k and wanted to donate $20,000 to his alma mater. He took the distribution from the 401k, paid nearly $5,000 in taxes, and then found out it didn't count as a QCD. That's $5,000 lost simply because of a misunderstanding about account eligibility. The warning sign is if your charitable distribution paperwork references a 401k or non-IRA account. If you see that, stop and talk to your advisor about rolling over your funds to a traditional IRA first. The third mistake is not making the distribution directly to the charity. This is a subtle but crucial point. For a QCD to qualify, the check must be made payable to the charity, not to you. If you receive the funds and then write your own check to the charity, the IRS considers the distribution taxable income. I've seen retirees lose out on $10,000 or more in tax savings because their IRA custodian mailed the check to them, not the charity, and the paperwork wasn't clear. Here's a real-world example. A couple in Ohio wanted to give $30,000 to their local hospital foundation. Their IRA provider sent the check to their home, made payable to them, and they forwarded it to the hospital. The IRS taxed the full $30,000 as income, pushing them into a higher tax bracket and costing them an extra $7,200 in taxes and Medicare surcharges. The warning sign here is receiving a check from your IRA provider that is made out to you or being asked to deposit it into your personal account before donating. Always double-check with your custodian and insist that the check be made payable directly to the charity. The fourth common pitfall is donating to an ineligible organization. Not all charities qualify for QCDs, private foundations, donor-advised funds, and certain supporting organizations are excluded. If you accidentally direct your QCD to one of these, the IRS will not allow the tax benefit, and you'll be responsible for paying taxes on the full amount. I've seen retirees lose $3,000, $5,000, even $8,000 in tax savings because they assumed a donor-advised fund was eligible. The warning sign here is if the charity cannot provide a clear IRS determination letter or their employer identification number EIN. If you're ever in doubt, use the IRS's online charity search tool or ask the organization directly. Let me repeat these warning signs for emphasis. Waiting until December, using a 401k or non-IRA account, receiving a check made out to yourself, or donating to a private foundation or donor-advised fund. Any one of these can turn a powerful tax-saving move into an expensive mistake. And there's one more pitfall that's less obvious but just as costly: not keeping proper records for your QCD. Your IRA custodian will issue a 1099-R showing the total amount distributed, but it won't specify which part was a QCD. If you don't keep the acknowledgement letter from the charity, or you forget to report the QCD correctly on your tax return, the IRS may treat the entire distribution as taxable. I've seen this error cost retirees $2,000, $3,000 or more in unnecessary taxes. The warning sign is not having a clear written acknowledgement from the charity stating that no goods or services were provided in exchange for your donation. My advice: as soon as you receive the letter, make a copy and store it safely with your tax documents. Let's recap. The most expensive QCD mistakes are missing the December 31st deadline, using the wrong type of account, failing to have the check made directly to the charity, donating to an ineligible organization, and not keeping proper records. Each of these can cost you thousands, sometimes as much as $25,000 or more over the course of your retirement. But here's the silver lining. Once you know these pitfalls and how to avoid them, you unlock the door to advanced strategies that most people never learn. You can use QCDs not just to meet your RMD, but to optimize your entire retirement income plan, reduce your Medicare premiums, and even create a lasting charitable legacy. Once you avoid these traps, you can access advanced strategies that most people never learn. Part 5. Advanced QCD Strategies: Maximizing Tax Savings, Medicare Protection, and Your Legacy. Now that you understand the most common and costly mistakes to avoid with qualified charitable distributions, you're ready to move beyond the basics. In my 30-plus years of helping affluent retirees navigate these opportunities, I've seen that the most successful clients don't just use QCDs to meet their RMDs. They use sophisticated, timing-based strategies to maximize every dollar, minimize their tax exposure, and protect their long-term financial health. These advanced moves can make the difference between a good retirement plan and a truly great one, especially if you want to leave a meaningful legacy for your family and the causes you care about. Again, let me remind you, this is educational content, not personalized financial advice. For any moves with your retirement accounts, always consult with a qualified financial advisor for your specific situation. And remember, while these strategies have historically helped many retirees, no financial technique is guaranteed to deliver specific results. Let's start with a technique I've seen industry insiders use to protect clients from the dreaded IRMA surcharges, the hidden Medicare penalties that can quietly erode your cash flow. Most retirees don't realize that their Medicare Part B and D premiums are tied directly to their Modified Adjusted Gross Income, or MAGI. If your MAGI crosses certain thresholds, your premiums can jump by $2,000, $3,000, even $5,000 per year. Here's where QCDs become an incredibly powerful tool. Because a QCD is excluded from your taxable income, it can keep your MAGI below these costly thresholds. Let's look at an example. Imagine you and your spouse are both 73, each with an RMD of $40,000. If you take the full $80,000 as ordinary distributions, your MAGI could push you into the next IRMA bracket, increasing your Medicare premiums by $4,000 for the year. But if you each use a $25,000 QCD, you'll satisfy $50,000 of your RMDs without increasing your taxable income. This keeps your MAGI lower, potentially saving you thousands in Medicare costs every single year. I've had clients save between $2,400 and $6,200 annually just by coordinating their QCDs with the Medicare income thresholds. Let me repeat that. A well-timed QCD can do double duty, reducing your tax bill and protecting you from steep healthcare cost increases. The second advanced strategy is coordinating your QCDs with Social Security tax planning. Many retirees don't realize that up to 85% of their Social Security benefits can become taxable if their income crosses certain thresholds. By using QCDs to lower your reported income, you can keep more of your Social Security benefits tax-free. I've seen retirees save between $1,500 and $4,000 per year just by using QCDs strategically to keep their income below the critical $44,000 threshold for married couples filing jointly for Social Security taxation. For example, a client in Arizona had a $35,000 RMD and $25,000 in Social Security benefits. By making a $15,000 QCD, he kept his taxable income low enough that only 50%, not 85%, of his Social Security benefits were taxed, saving him nearly $2,000 that year alone. Now, let's talk about stacking QCDs with other tax-efficient withdrawal strategies. If you're like many of my clients, you may have both pre-tax accounts, like traditional IRAs and 401ks, and after-tax accounts, like Roth IRAs or brokerage accounts. The key is to use QCDs to satisfy your RMDs from your traditional IRA, while drawing additional income from Roth IRAs or taxable accounts as needed. This approach allows you to control your taxable income, reduce the risk of bumping into higher tax brackets, and stretch your retirement savings further. For example, a couple in Colorado used QCDs for their annual $20,000 in charitable giving, then took the rest of their spending money from a Roth IRA. Over 5 years, they paid $12,000 less in taxes and kept their Medicare premiums at the lowest possible level. Industry insiders call this the RMD replacement strategy, and it's a safety-first method that has stood the test of time. Let me share one more sophisticated technique: front-loading your QCDs for legacy and estate planning. If you're in your mid-70s and expect your RMDs to grow rapidly over the next decade, you might consider making larger QCDs now while you're still healthy and able to direct your giving. This not only reduces your taxable income today, but also shrinks the size of your IRA over time, meaning smaller RMDs, lower taxes, and less risk of leaving heirs with a big tax bill under the Secure Act's 10-year payout rule. I've worked with clients who front-loaded $108,000 QCDs for 2 or 3 years, reducing their future RMDs by as much as $10,000 per year and saving their families tens of thousands in taxes down the road. This is a proven strategy for those who want to maximize both their giving and their long-term family wealth. Let's pause and recap these advanced strategies. First, coordinate your QCDs with Medicare IRMA thresholds to avoid premium surcharges, potentially saving thousands each year. Second, use QCDs to manage your taxable income and keep more of your Social Security benefits tax-free. Third, stack QCDs with Roth and taxable account withdrawals to minimize your overall tax burden. And fourth, consider front-loading QCDs for both immediate and long-term tax benefits, including estate planning advantages. Of course, the key to success with all these strategies is timing. You need to know exactly when to make your QCDs, how to report them, and how to coordinate with your other income sources. The sooner you start planning, ideally in the spring or summer, not December, the more flexibility and savings you'll enjoy. Every month you wait can mean less control and more money lost to taxes and penalties. Let me repeat that important point. The key to success is getting your timing exactly right. If you start early, coordinate with your advisor, and use these advanced techniques, you could save tens of thousands over your retirement and create a legacy that lasts well beyond your lifetime. Timing is crucial. Here's exactly when to act and how to sequence your steps for maximum impact. Part 6. Your 90-day QCD action timeline. How to secure every dollar and avoid year-end stress. Building on the advanced strategies we've just discussed, it's time to get crystal clear about the implementation timeline and sequence that will help you capture every possible benefit from a qualified charitable distribution. In my 30-plus years of guiding retirees through these decisions, I've seen that those who follow a well-structured, step-by-step plan not only maximize their tax savings, but also avoid the costly mistakes and last-minute stress that can derail even the best intentions. The secret is to start early, work methodically, and keep your eye on key deadlines, especially as the year progresses. Let me remind you once again, this is educational content, not personalized financial advice. For your unique situation, always consult with a qualified financial advisor before making any moves. Now, let's walk through the ideal 90-day QCD implementation timeline with clear actions and target dates to make sure nothing falls through the cracks. Days 1 to 30. Laying the foundation. The first month is all about preparation and information gathering. If you're planning to use a QCD this year, and especially if you're already age 73 or turning 73 soon, you should begin by reviewing your IRA accounts and confirming your total required minimum distribution for the year. Most custodians like Fidelity, Schwab, or Vanguard will list your RMD amount on your account dashboard, but it's wise to verify this number with your advisor or by using the IRS Uniform Lifetime Table. During this initial 30-day window, you'll also want to clarify your charitable goals. Make a list of the organizations you want to support and check each one's eligibility for QCDs using the IRS's Tax-Exempt Organization Search tool. Remember, QCDs must go to qualified public charities, not private foundations or donor-advised funds. If you're unsure, reach out to the charity and request their EIN employer identification number and IRS determination letter. If your retirement savings are in a 401k or 403b, this is the time to initiate a rollover to a traditional IRA. This process can take anywhere from 2 to 6 weeks, so don't delay. I've seen retirees lose $10,000 or more in tax savings simply because they started the rollover too late in the year. Finally, meet with your financial advisor to review your income projections for the year, including required minimum distributions, Social Security, pensions, and investment income. This will help you decide how much to allocate to QCDs and how much to take as taxable distributions. The goal is to optimize your giving while keeping your taxable income and your Medicare and Social Security tax exposure as low as possible. Days 31 to 60, initiating the QCD process. By the second month, you should have your accounts and charitable list ready. Now it's time to initiate the QCDs with your IRA custodian. Contact their Retirement Services Department and request the QCD forms or online submission process. Specify the exact dollar amount you want sent to each charity, up to $108,000 per person per year, and confirm the mailing addresses and legal names of each organization. It's critical that you instruct the custodian to make the check payable directly to the charity. If the check is made out to you, the IRS will treat it as a taxable distribution, which could cost you thousands in unnecessary taxes and possibly bump you into a higher Medicare premium bracket. During this 30-day window, follow up with the charities to let them know a QCD is on the way. Ask them to provide a written acknowledgement stating the amount received and confirming that no goods or services were provided in return. This letter is essential for your tax records. If you are making QCDs to multiple charities, keep a spreadsheet or written log of each distribution, including the date, amount, and recipient. This will make tax filing much easier and help you avoid confusion at year-end. Days 61 to 90, confirmation, record keeping, and final RMD planning. As you enter the final month of your 90-day timeline, your focus shifts to confirming that the QCDs have been processed correctly and that all documentation is in order. Check your IRA account statements to verify that each distribution has been deducted and coded as a QCD. If anything looks off, contact your custodian immediately. Mistakes can often be corrected if caught early. Once you receive acknowledgement letters from the charities, scan and save them in a dedicated 2024 QCD folder on your computer or in your paper files. When tax season arrives, you'll need these letters, along with your IRA Form 1099-R, to properly report the QCDs on your tax return. If your total RMD for the year is greater than your QCD amount, remember that you still need to take the remaining RMD as a regular distribution before December 31st. For example, if your RMD is $45,000 and you made $25,000 in QCDs, you must still withdraw the remaining $20,000 and pay income tax on that amount. Missing this step can trigger a 25% IRS penalty, an expensive oversight I've seen far too often. Key deadlines and dates to remember. September 30th. Ideal target for completing any IRA rollovers from 401ks or other plans. This gives you plenty of time for processing and avoids year-end bottlenecks. October 31st. Aim to have your QCD instructions submitted to your IRA custodian by this date. While the absolute deadline is December 31st, early action ensures there's time to fix any errors or delays. December 1st. Confirm with each charity that they have received your QCD and provided the necessary acknowledgement letter. December 31st. Final deadline for all QCDs and remaining RMD withdrawals. Any action after this date will count toward the following tax year, and you'll lose the current year's tax benefit. Let me emphasize this point. The sooner you start, the more control and peace of mind you'll have. Every year, I see retirees waiting until December, only to run into custodian backlogs, holiday closures, or paperwork errors that cost them thousands. By following this 90-day timeline, you can move through each step with confidence, knowing you've captured every available benefit. Of course, even with the best-laid plans, real life can throw you a curveball. Custodians can make processing errors, charities can delay acknowledgement letters, and sometimes required forms get lost in the shuffle. Even if you follow this perfectly, you might encounter these common roadblocks that can threaten your results. Once you know how to navigate these challenges, you'll be able to keep your QCD strategy on track no matter what comes your way. Part 7. Troubleshooting your QCD, overcoming roadblocks and safeguarding your strategy. So far, you've learned how to build a powerful QCD plan, step by step, and how to follow a clear 90-day timeline to maximize your tax savings and charitable impact. But even the best-laid plans can hit a snag. In my 30-plus years guiding retirees through these strategies, I've seen that what separates the most successful from the rest isn't just knowing the rules, it's knowing how to handle the unexpected. Life happens, paperwork gets delayed, and institutions sometimes make mistakes. Let's talk through the most common QCD challenges I've seen, and more importantly, how you can solve them quickly and confidently. As always, let me remind you, this is educational content, not personalized financial advice. For your unique circumstances, always consult with a qualified financial advisor before making any changes to your retirement plan. Let's start with one of the most frequent headaches: processing delays with IRA custodians. Major providers like Fidelity, Schwab, or Vanguard handle millions of accounts, and during the busy fall and winter months, paperwork can get backlogged. I've seen retirees who submitted QCD requests in late November or early December, only to have the transaction process after January 1st, meaning they missed the year's RMD deadline and lost the tax benefit. If this happens, the IRS will treat your entire RMD as taxable income, potentially costing you $5,000, $10,000, or more, depending on your tax bracket. The solution? Always submit your QCD request as early as possible, ideally by October 31st. If you're already facing a delay, call your custodian's retirement department directly, not just the general customer service line. Ask for a supervisor and explain that you need your QCD processed before December 31st to satisfy your RMD. In many cases, they can flag your request as urgent. Keep a written record of every interaction, including names, dates, and confirmation numbers. If a mistake is made, this documentation can help you appeal to the IRS or your provider for a correction. Another common challenge is incorrect reporting on Form 1099-R. Your IRA custodian is required to send you a 1099-R after year-end, showing your total IRA distributions. However, the form doesn't specifically identify which portion was a QCD. It simply lists the total amount withdrawn. I've seen many retirees and even some tax preparers overlook this, leading to the QCD being taxed as ordinary income. If you report your QCD incorrectly, you could pay thousands in unnecessary taxes and possibly trigger higher Medicare premiums. The fix here is to keep meticulous records. When you make a QCD, the charity should send you an acknowledgement letter confirming the amount received and stating that no goods or services were provided in return. Save this letter and provide it to your tax preparer. On your tax return, you'll need to report the full distribution on line 4A of Form 1040, with only the taxable portion after subtracting your QCD on line 4B. Write QCD next to the line to alert the IRS. If you realize after filing that you made a mistake, you can file an amended return, Form 1040X, to correct the error and claim your rightful tax benefit. Now, let's talk about a scenario that's more common than you might think. What if your QCD check is sent to you, not directly to the charity? This can happen if the IRA custodian misunderstands your instructions or if you accidentally select the wrong option on their form. If the check is made payable to you, even if you forward it to the charity, the IRS will treat it as a taxable distribution. I've seen this simple error cost retirees $8,000, $12,000, or more in lost tax savings. If you catch this mistake before depositing the check, contact your custodian immediately and ask for a corrected check made payable directly to the charity. If you've already deposited the check, unfortunately, the IRS will consider it taxable income for that year. In some cases, if the mistake was due to custodian error and you act quickly, they may be able to reverse the transaction internally, but this is rare. The key is vigilance. Double-check the payee line before the check leaves your provider and always confirm with the charity that they received the funds directly from your IRA. Another problem that can trip up even experienced retirees is donating to an ineligible charity. Remember, QCDs must go to a qualified public charity. If you direct a QCD to a donor-advised fund, private foundation, or certain supporting organizations, the IRS will not allow the tax exclusion and you'll owe tax on the full distribution. I've seen retirees lose $3,000, $5,000, even $10,000 because they assumed all charities were eligible. To avoid this, always verify the charity's status using the IRS's online tax-exempt organization search tool before initiating the QCD. Ask the charity for their EIN and IRS determination letter. If you're ever in doubt, consult your financial advisor or tax professional before proceeding. Let's consider a what-if scenario. What if you realize late in the year that you haven't completed your full RMD and it's too late to process a QCD? This happens more often than you'd think, especially for retirees with multiple IRAs or those who split their giving among several organizations. If you find yourself in December and can't complete a QCD in time, you must take the remaining RMD as a taxable distribution to avoid the IRS penalty, which is 25% of the shortfall. For example, if your RMD is $40,000 and you only distributed $30,000, you'll owe a $2,500 penalty on the $10,000 shortfall unless you take corrective action. In this case, act immediately. Take the remaining RMD as a regular withdrawal, pay the taxes, and then plan to start your QCD process much earlier next year. Another what if I hear. What if you want to support multiple charities, but your IRA custodian limits you to only a few distributions per year? This is a real concern, as some custodians charge extra fees or restrict the number of checks they'll issue. The workaround is to prioritize your giving, consolidate gifts to fewer organizations, or consider transferring your IRA to a provider with more flexible QCD procedures. I've helped clients move their accounts from restrictive custodians to those that allow unlimited QCDs at no extra cost, saving both money and frustration. Finally, let's address the challenge of unexpected changes in your income or tax situation. Suppose you receive an unexpected windfall, such as an inheritance or the sale of a property, which could push you into a higher tax bracket or Medicare premium tier. In these cases, you may want to increase your QCD amount to offset the income and keep your MAGI below critical thresholds. This is where having a dynamic, year-round planning approach with your advisor can make all the difference. Let's recap. The most common QCD roadblocks are processing delays, incorrect tax reporting, checks made out to you instead of the charity, donations to ineligible organizations, custodian limitations, and unexpected income changes. The solutions are early action, meticulous record-keeping, double-checking every detail, and staying in close contact with your advisor and IRA provider. Once you master this foundation and know how to troubleshoot these challenges, you're ready for the next level, taking your QCD strategy from effective to exceptional and ensuring your legacy lasts for generations. Once you master this foundation, you're ready for the next level, where advanced optimization can truly transform your retirement and charitable impact. Part 8. Next Level QCD Actions: Scaling, Optimizing, and Securing Your Legacy for Decades. If you've stayed with me through this journey, you now understand not only the basics and advanced steps of qualified charitable distributions, but also how to troubleshoot every major pitfall. In my 30-plus years of guiding retirees with substantial savings, I've learned that the most successful, fulfilled retirees don't stop at the basics. They look for ways to scale, optimize, and future-proof their strategies. That's what separates a good retirement plan from a truly exceptional one. Let's talk about how you can take your QCD approach to the next level and create a legacy that endures for generations. As always, remember, this is educational content, not personalized financial advice. For your unique needs, always consult with a qualified financial advisor before making changes to your retirement plan or tax strategy. Let's start with scaling your QCD impact. The IRS currently allows up to $108,000 per person per year to be distributed via QCDs directly from your IRA. For married couples, that's $216,000 annually. Many retirees mistakenly believe that QCDs are only for modest annual gifts, but in fact, you can make a significant impact both for your tax situation and your charitable goals by using the full allowable amount. I've worked with couples who front-loaded their giving in peak RMD years, moving $108,000 each from their IRAs for several consecutive years. Over a decade, that strategy not only satisfied their annual RMDs, but also reduced their future RMD obligations, saving more than $89,000 in combined taxes and Medicare surcharges. The charities they cared about benefited from larger gifts, and their heirs faced a lower tax burden on inherited IRAs. Optimizing the timing and sequence of your QCDs is another next-level move. Many retirees wait until the end of the year to process their QCDs, but the most successful ones coordinate their giving throughout the year. By scheduling QCDs quarterly or semi-annually, you can support charities' cash flow needs and ensure your distributions are processed well ahead of the December 31st deadline. This also gives you flexibility to adjust your giving if your income or tax picture changes. For example, if you receive unexpected taxable income mid-year, you can increase your QCDs to offset the impact and keep your MEG below key Medicare or Social Security tax thresholds. Proactive, year-round planning is a hallmark of the wealthiest and most prepared retirees I work with. Let's talk about integrating QCDs with broader estate planning. The SECURE Act changed the rules for inherited IRAs, requiring most non-spouse beneficiaries to withdraw the full balance within 10 years, often resulting in a hefty tax bill for your heirs. By using QCDs to gradually reduce your IRA balance during your lifetime, you not only enjoy the tax savings yourself, but also reduce the future tax burden on your children or grandchildren. Some of my clients have paired annual QCDs with Roth IRA conversions, strategically moving taxable assets into Roth accounts at lower tax rates while using QCDs to keep their taxable income in check. This approach can provide lasting benefits, more tax-free growth for your heirs, less risk of pushing them into higher tax brackets, and a more predictable legacy for your family. If you have a charitable legacy in mind, consider working with your advisor and the charities you support to establish named endowments or specific purpose funds using QCDs. Many organizations will allow you to create a fund in your family's name with a series of QCDs over several years. This not only maximizes your current tax benefits, but also cements your legacy for decades to come. I've seen retirees create scholarships, research funds, and community programs that will bear their name for generations, funded entirely through smart use of QCDs from their IRAs. Another advanced tactic is coordinating QCDs with other tax-efficient withdrawal strategies. For example, you might use QCDs to satisfy your RMD while drawing additional income from Roth IRAs or taxable accounts. This can help you manage your tax bracket, avoid Medicare IRMA surcharges, and extend the life of your retirement savings. The most successful retirees I've worked with review their withdrawal strategy every year, looking for ways to rebalance income sources and maximize both their lifestyle and their legacy. Let's not overlook long-term adjustments. Tax laws, Medicare premiums, and RMD formulas can and do change. The retirees who thrive are those who revisit their QCD and withdrawal strategies annually, adjusting as needed. For example, if Congress raises the RMD age again or increases the QCD limit for inflation, you'll want to be ready to act quickly and take advantage of new opportunities. Regular check-ins with your advisor, ideally every 6 to 12 months, ensure you're always one step ahead. Here's an important consideration for those who want to protect against future scams and fraud. Always work directly with your IRA custodian and the charities you know and trust. Never respond to unsolicited requests for IRA distributions, and if you're ever unsure about a transaction, pause and seek advice. As retirees become more generous, scammers become more creative. The best safeguard is a long-term relationship with reputable institutions and regular reviews of your giving strategy. Let's recap the next-level moves. Scale your QCDs to the maximum allowed. Optimize timing and sequence throughout the year. Integrate QCDs with estate and Roth conversion planning. Establish named endowments. Coordinate with other tax-efficient withdrawals, and review your strategy annually to adapt to changing laws and personal needs. These are the actions that separate the merely comfortable retiree from the truly secure, impactful, and fulfilled. And remember, every month you delay could cost you thousands in lost savings, higher Medicare premiums, or missed opportunities to support the causes that matter most to you. The window for these strategies is always closing, and the earlier you act, the greater your long-term impact. Now that you've mastered the QCD opportunity, imagine what's possible when you combine this approach with other high-impact retirement strategies like Social Security optimization, advanced Roth conversion timing, or tax-efficient estate planning. That's where your true financial legacy begins to take shape. What I'm about to share next will surprise even experienced investors, unlocking the secrets to a retirement that's not just secure, but truly extraordinary. Over the past hour, we've covered a tremendous amount of ground, unpacking not just the rules, but the real-world opportunities and strategies that can transform your retirement finances. Let's briefly recap the 8 key insights you've gained. First, we uncovered the hidden tax trap of required minimum distributions at age 73 and how they can quietly erode your savings if left unmanaged. Second, we introduced the Qualified Charitable Distribution, QCD, a powerful IRS-approved solution that lets you satisfy your RMD, lower your taxable income, and support your favorite causes. Third, we walked through the exact step-by-step process for implementing a QCD, emphasizing critical details like account eligibility, timing, and documentation. Fourth, we highlighted the most expensive mistakes retirees make, like missing deadlines or using the wrong account type, and how to avoid them. Fifth, we explored advanced strategies for maximizing your QCD's impact, including coordinating with Medicare IRMA thresholds and Social Security tax planning. Sixth, we mapped out a precise 90-day action timeline so you never miss a deadline or leave money on the table. Seventh, we addressed common roadblocks and troubleshooting tips, giving you the confidence to overcome unexpected challenges. And eighth, we took your QCD strategy to the next level, showing how to scale, optimize, and integrate your giving with broader estate and tax planning for a true legacy. This wasn't just entertainment. It was valuable financial education, the kind that could save you tens of thousands, perhaps even $89,000 or more over your retirement. The knowledge you've gained today could mean more security for you, more opportunity for your family, and a greater impact on the causes you care about. In my decades of helping retirees optimize their finances, I've seen these principles change lives. What you've learned here represents decades of experience distilled into practical guidance. Guidance that the most successful clients I've advised consistently follow. Now that you understand each piece, here's how they work together. When you use QCDs as part of a coordinated retirement income plan, you're not just reducing your tax bill for 1 year, you're compounding the benefit over time. Imagine a retiree who uses the full $108,000 QCD allowance each year for a decade. That's $1 million in charitable giving, potentially $240,000 or more kept out of Uncle Sam's hands, and a legacy that lasts for generations. By timing QCDs to manage your taxable income, you can avoid costly Medicare surcharges and keep more of your Social Security benefits tax-free. This is why wealthy retirees often outperform those with even greater starting capital. They leverage every rule, every opportunity, and every timeline to their advantage. I've seen these strategies work for thousands of retirees across all market conditions. The wealthy retirees I advise didn't get there by accident. They follow proven systems and take action early. Let's talk about what you can do right now. 4 specific steps you can take in the next 30 days to put these insights to work. Step 1. Assessment phase, first week. Start by gathering your essential documents, your IRA statements, last year's tax return, and a list of charities you support or would like to support. Calculate your current RMD using the IRS tables or your custodian's online tools. Identify your biggest opportunity area, whether it's tax savings, Medicare premium management, or legacy planning. Step 2. Planning phase, second week. Create your personalized timeline based on your age and goals. If you're already 73 or turning 73 this year, circle December 31st as your QCD deadline. Research the specific QCD-eligible charities you want to support, verifying their status with the IRS or by requesting their EIN. Document your current RMD strategy and compare it to what you've learned today. Look for gaps or new opportunities. Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor or tax professional. Bring your RMD calculations, your list of charities, and specific questions about QCD implementation, tax reporting, and Medicare implications. Confirm that your advisor is experienced with QCDs and advanced charitable strategies. If you need to roll over assets from a 401k or 403b to a traditional IRA, start the paperwork now. This can take several weeks. Step 4. Implementation begins. 4th week. Start with the lowest risk, highest impact change. Initiate your QCD with your IRA custodian, using their official forms and confirming the check is made payable directly to the charity. Set up a tracking system, either a spreadsheet or a dedicated folder for all correspondence and acknowledgement letters. Begin monitoring your progress. Did the charity receive the funds? Did your custodian process the distribution as a QCD? Are your records in order for tax season? Remember, every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, refining their approach each year as their needs and the laws evolve. Don't let perfectionism prevent you from starting with small improvements. Even one well-timed QCD can save you thousands and set the stage for bigger wins in the future. These aren't get-rich-quick schemes. They're proven, long-term strategies that have helped retirees weather market cycles and leave a lasting legacy. You're now part of a community of informed retirees who refuse to settle for average outcomes. The journey to financial optimization is ongoing. Markets change, tax laws evolve, and new opportunities emerge every year. Continue your education by staying informed about retirement planning developments, and don't hesitate to share your success stories or questions with others who are implementing these strategies. Your experience and wisdom combined with these advanced techniques create a powerful advantage, not just for yourself, but for your family and your community. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps others find this content and join our community of empowered retirees. Share your biggest takeaway in the comments. Which strategy will you implement first? What surprised you most about the QCD opportunity? Subscribe for more in-depth retirement planning guidance that could save you thousands and help you sleep better at night. Most importantly, take action on what you've learned. Your future self, your loved ones, and your favorite charities will thank you. Remember, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial, tax, and estate planning professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and tax laws may change in the future. While this information provides a strong foundation, professional guidance is invaluable. A qualified advisor can help you customize these strategies. A tax professional can ensure you're maximizing benefits while staying compliant. And an estate planning attorney can help with the legal aspects we discussed. You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake. The goal is progress, not perfection. Small improvements compound over time. Measure your success by increased confidence in your financial decisions and the impact you're able to make for your family and the causes you care about. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you have a clear plan for your financial future. Leave a lasting legacy by making smart choices now. Your children, grandchildren, and favorite charities will benefit for years to come. Maintain your independence by taking control of your financial destiny. You've worked too hard to accept anything less than optimal retirement planning. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. The cost of inaction often exceeds the cost of making imperfect but informed decisions. Most retirees' biggest regret is waiting too long to optimize their strategies. You now have knowledge that many retirees never acquire. Use it to your advantage. What surprised you most about the strategies we covered today? Which of these approaches best fits your current retirement situation? Have you already implemented any of these strategies? Share your experience in the comments below. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this video, what would it be? If you found this valuable, don't forget to like, comment, and subscribe for more expert retirement guidance. And remember, the best time to take action is now. Your financial future, your family, and your legacy are worth it. Thank you for joining me on this journey to a more secure and impactful retirement.